Hey everyone, welcome back to the Weekend Charts, the show where I run through the most important charts and themes in markets and investing. Huge show for you today. We have a lot to talk about. I want to start out with the US equity market, and here come the bulls. And what do I mean by that? Well, if you look at investor sentiment, you've heard me say a number of times over the last year, bears really were dominating the landscape. We saw a record number of weeks where bears outnumbered bulls in this individual investor poll pretty much most of the back half of last year. And even this year, as the market has rallied higher and higher, we had that brief period in February where sentiment spiked higher. But after Silicon Valley Bank failure and the debt ceiling, the bears came back into control. But over the past few weeks here, we've seen bullish sentiment really spike higher. And now we have a 20% spread between bulls and bears. So bulls 20% higher than bears. That's the highest spread we've seen since November 2021. And at the same time, we have this active equity exposure index from NAAIM, and that's showing the highest levels of exposure, 90%, to the US equity market since November 2021. So signals are building that investors are becoming more optimistic. Now, I wouldn't read into this the same way we read into extreme negative sentiment last year, where you tend to see above average future returns going forward and strong positive returns. You don't necessarily get the same signal off of high levels of sentiment. What you do find, though, is often the case is you have below average returns, but still positives. But what I would say here is we're losing that positive factor. We're losing that wall of worry. So we have one less thing, I guess you could say, to be positive about, which is the lack of negativity. And why are investors becoming more positive here? Well, very simply, sentiment follows price. And as price moves higher, investors should be becoming less bullish, but instead they become more bullish. It's counterintuitive. It's the opposite of, let's say, when you go into a store and you like to buy things on sale when prices to go down, you get more excited about it. In the stock market, investors really behave the opposite, where when prices go up, they become more and more enthusiastic about those prices. And so what we've seen now is a 23% rally in the S&P 500. That's the biggest rally we've seen since the stock market peaked in 2022, in January of 2022. We had a number of rallies, of course, last year, but this has exceeded them all in terms of magnitude and importantly in terms of duration as well. So now we're going further and further away from those October lows. And I think that the memory of the declines last year is starting to fade, and investors are talking more about tech and NVIDIA, AI, and all of that stuff. And that's getting investors much more bullish than they were. Now, in terms of volatility, what we've seen is a reversal of what we saw last year. Last year, we had kind of persistently elevated levels. We never saw a super spike higher. So the VIX never got above 40 last year, but a number of times it was above 30. This year, we've seen volatility collapse. And after the debt ceiling resolution, we saw the VIX really plummet here. Now it's below 14. That's the lowest we've seen since before the start of the pandemic. So you got to go back to February 2020 in terms of the VIX and market volatility. And that has investors, of course, asking the question, well, is this too much complacency? Is this a sell signal like it was in early 2020? The historical data doesn't really suggest that to be the case. If you look at the lowest levels of VIX historically, so like let's say the bottom 10% of readings, what you tend to find is market level of returns going forward. So there's really no signal to a low level of VIX. It's not the same, similar to sentiment. It's not the same as extremely high levels of VIX. So what we talked about last year was that these spikes above 30, there was a signal there. And what we find historically is that the highest 10% of VIX levels, so above 28.6, we see better future returns for the S&P 500. So over the next year on average, you have 23% gain, 2 years, 39%, and so on. 5 years out, you see a better return following these VIX spikes. So extreme fear tends to be good for the market, but complacency in terms of what we have today, there's not necessarily a signal there that can continue for some time. We saw that, of course, during 2017 being a great example where the entire year the VIX remained very low and there wasn't there wasn't this big crash that came thereafter. So it can happen. Again, we've seen many periods in history where you can have low volatility persist for years, but there's no rhyme or reason to the VIX. So we could just as easily see the VIX spike in the next few weeks or the next few months. I wouldn't be surprised by others, any of those outcomes. What you do tend to see in terms of volatility is a reversion to the mean. So historical average is 19.66, and at some point, we don't know when it's going to go hit that average again, and of course, it'll go above it. And then when it goes above it, you'd expect it to come down. So mean reversion from the VIX is to be expected, but the level itself, particularly at low levels here, is not telling you anything in terms of what the market's going to do going forward. Now, why are investors getting more bullish? Where did that wall of worry go? Well, I want to run through really the factors that were driving last year's decline, and starting with, of course, inflation. So that was the biggest fear, and inflation really peaked in June of last year in terms of the year-over-year rate of change. We had 9.1% CPI last June, and since then we've seen it come down every single month. This month, when we get the inflation data next week, it's expected to come down all the way to low 4%. So pretty much a 5% decline in the inflation rate. That has investors feeling, of course, much better. That ties in with the second reason here. Investors were really negative on the market all of last year and coming into this year as well, is this rising interest rate, Fed tightening environment. And in terms of hiking interest rates, investors now are looking ahead. They're saying that we're going to talk about this in a little bit, but the Fed is likely to pause in June. And even if they do hike again, the market is not expecting maybe one more hike, but nothing after that. So that's kind of alleviated in terms of the worry. The Russia-Ukraine war was a big factor last year, particularly with the spike in commodity prices. And while the war is still ongoing, at least it hasn't escalated. That's a good thing. And what we've seen in terms of commodity prices is they've come down a lot over the last year. So the fears in terms of higher food prices and other factors stemming from the war, they haven't persisted. So that fear is kind of being delayed for now. And then lastly, recession fears. There's definitely still out there, but with each passing month, and we'll talk about this at the end of the video, in terms of the employment numbers, I think people are starting to push out their projections in terms of when the recession potentially is going to begin. So you have these four factors really driving things last year on the downside, and this year people feeling much better about all four of them. And so probably not surprising with that 23% rally and these factors becoming less of an issue, that investors are finally bullish again. So next topic I want to talk about, the sky's the limit. And what do I mean by that? Well, that's the US national debt. And why is the sky the limit? Because they decided to suspend the debt ceiling, which is what we expected. They pushed it off now until January 2025. And now the debt is free to rise as much as the government wants to spend. So some of the details from that debt ceiling agreement. Of course, it was suspended until January 2025, which is interesting after the election. So this won't be an issue before the election. We'll wait to see the outcome of that election. Depending if it's a split government again, then I would expect to see a similar type of fight looking forward in January 2025. But what did they agree to? The big things? Well, they said that non-defense spending was going to be flat in 2024. And only a 1% increase in 2025. So slower rate of growth in terms of the increase on that area of spending. And on defense spending, 3% increase going forward. Some people are suggesting that's too low. Congress can always, with all of this stuff, can always come in and pass new bills to increase spending if they choose. So this is not definitive by any means. All of this is subject to change. But by freezing non-defense spending this year and only 1% increase next year, and decreasing defense spending to 3% increase. Well, that alone, if that were to continue, I guess, over the next decade, is going to save the government $1.5 trillion. So looking at 150 billion a year in terms of savings. But that's the estimate, assuming nothing changes, and a lot obviously is going to change going forward. So in terms of COVID funds, 30 billion was unspent, and so they rescinded that. There was some little bit of welfare reform where they increased the age requirement to receive benefits. You have to now uh, able-bodied adults have to work 20 hours if they're up to 54 instead of up to 50. So they raised that a little bit. Minor issue there. The IRS, there was a big fight about that. There was some talk about maybe perhaps that in the Inflation Reduction Act, they approved over 80 billion in terms of new funding for the IRS. The Republicans were looking to cut that way down. What they got was a compromise $20 billion directed to non-defense spending. And in terms of energy permits, this was, I think, a request from Joe Manchin to get the deal through, and it's going to make it easier, supposedly, to have these fossil fuel and renewable energy projects to get licenses. And we talked about that last year, how the number of licenses that were issued just really plummeted last year, and that was a factor driving prices higher and will continue to be going forward if they don't give these new licenses. So a good thing there. And finally, on student loans, they didn't do anything in terms of the forgiveness. They said that's going to be decided by the Supreme Court sometime this summer, but they did confirm that there will be an end to the pause on payments by the end of August this year. So the average student loan payment, I think, is $400 or $500 a month, and now it's been 3 years since people have had to make a payment on those loans. So, in starting in September, you're going to see a resumption of that. So that will be an interesting thing to watch in terms of, does that affect discretionary spending? Because of course, if you're spending $500 a month on student loans, $6,000 a year, that's money you can't now spend elsewhere. So you had that savings, and now that's going to become a factor for people in terms of spending. And if we look at sovereign CDS spreads, this is something we showed a few times over the past few weeks. We saw that huge spike higher in terms of spreads, and people were saying, well, this is a sign that there's going to be a default. Why would people be betting on this? Why would they be buying insurance in terms of betting on the default if they didn't think that it was possible? And as we said, this is nonsense. It's not going to, the US government is not going to default. They're going to make their payments, and this is going to come right back down. And that's exactly what ended up happening here. We're looking now at 11 basis points from 157 at its peak. So now that there's no limit on the debt, what's going to happen over the next few months? Well, the US government's going to start borrowing money again. You're going to see the national debt start to increase at a pretty rapid pace to kind of replenish that general account that we showed was depleting for many months. And that's already begun. So June 2nd we have this 31.4 trillion ceiling, and that had been going on for months. And now that's been lifted. And the very next day, we saw a $358 billion increase in the national debt. So that's the biggest single day increase ever. And what we should expect in the coming weeks and months is we're going to hit that $32 trillion national debt milestone. So what they agreed to in terms of lowering the spending rate of increase, that's not going to, you're still going to have a massive deficit of close to $2 trillion. And that's going to drive national debt higher in the short run unless they make bigger changes going forward. So what happened in terms of yields? We had been talking about 1 month yield, how it was going crazy in both directions because of the supposed debt default that was going to happen. So initially you had people rushing into that 1 month, driving its yield lower. And then as we got closer to the debt ceiling deadline, so to speak, you had people getting out of the 1 month bill saying it was going to be extremely risky because if the US defaulted, that would be the bill that was going to not get paid back. And then you saw yields rise up to over 6%. But as we said in the last video, as soon as this deal is reached, you're going to see this normalize. That's exactly what has happened. We've seen the 1 month yield now come down from 6% to 5.25%, and now below that 3 month yield at 5.38. So more normal environment now for treasury bills. These are going to be driven now going forward by Fed policy and expectations in terms of Fed policy. So if the Fed hikes rates again, you're going to see these move higher. If the Fed pauses, you see them stable. and the Fed is expected to cut rates, you'll start to see them drop. So let's talk about the equity market and calling this the enormous eight, for lack of a better word. These eight stocks in the S&P 500 becoming more and more powerful. You got Google, Amazon, Apple, Facebook, I still call it Facebook, Microsoft, Netflix, Nvidia, and Tesla. So eight stocks were 22% of the S&P at the start of the year. Now they're over 30%. The reason for that is the massive, massive gains in these eight companies, technology sector in general. And if we look at the biggest winners year to date in the S&P 500, you have a number of these names dominating this list, which is not always typical because these companies are among the biggest companies in the index, and they're also among the best performers. So we have Nvidia leading all stocks, Facebook here number two. We have Tesla here over 70% gain. We have Amazon 48% gain, and Google down here at over 40%, and Apple and Microsoft not far behind. So just incredible, incredible gains for these stocks in 2023. And what that has led to, because the average stock hasn't done very well, is the widest spread on a year-to-date basis that we've ever seen between the S&P 500 overall, which is market weighted, and the equal weighted version of the S&P 500, which is simply each of the 500 stocks is given the same weight. So we're seeing an over 10% spread through June 5th of this year, where the S&P 500 is outperforming its equal weight counterpart. Now, historically, this is very, very unusual. I don't expect this to continue at this pace. Anything could happen in the short run. But as we've talked about, we're kind of getting to an extreme in terms of large cap versus small cap, large cap versus equal weight. And I wouldn't be surprised to see a reversion to the mean in the opposite direction. So if we're talking about reversion to the mean here, what we've seen in terms of technology is simply incredible. Move on a relative strength basis back to its highest levels since August 2000. And if you remember here in late 2021, this relationship peaked in terms of tech outperforming the S&P 500. Then we had a pretty sizable move lower last year, and many people were saying, well, this is similar to the peak back in 2000, March 2000. We're going to see a multi-year trend of lower relative strength for technology, so technology underperforming. Well, that hasn't happened. With the AI revolution here, this has gotten a new life, and we've seen the ratio now at its highest level since 2000. So very interesting to see. Tech really doesn't want to die. Big tech doesn't want to die, and it's now back to its levels since August 2000. Now, there's nothing to say that this won't continue to go up. What I would tell investors when they look at a chart like this is be mindful of the history here. So we have had and we've seen many time periods where technology has gone years, if not decades, underperforming the index as a whole. So just holding the technology sector, looking ahead the next 10 years, because it's been a big winner the last 10 years, it's tempting to say, I don't need to own any other sector, just put everything in tech. But if you look back in 2000 to 2010, you could see why it was important to hold other sectors, to be diversified, because you can have these long periods of underperformance for this sector. And if we look at expectations today in terms of technology, I wouldn't say that they're as high as 2000 by any means, but they're certainly at their highest point since 2000. So if we look at companies, as we talked about last week, like Nvidia, trillion-dollar company trading at close to 40 times sales, we haven't seen that historically in any other time period other than 2000. So a lot of high expectations for tech. Maybe those expectations will be met, but on the chance that they won't, it's helpful. It's going to be helpful to own things other than just technology. If we look at the commercial real estate market, this was an interesting data point here on interest only loans and how there's going to be problems from them likely to come. So if we go back to 2010 and look at CMBS, so commercial mortgage backed securities, look at the percentage of loans that were interest only. So you only have to make the interest payment. You don't have to make any principal payment on that loan. You were under 20% back in 2010. And if we fast forward to 2021 at the peak, this rose to all the way to 88%. So 88% of the CMBS loans in 2021 were interest only. And where this starts to become problematic, obviously, is if the values of commercial real estate don't continue to go up and you have higher interest rates today than you did a few years ago. So we have now both of those factors going on at the same time, particularly in the office market. And what this Wall Street Journal article was talking about is over the next 3 years, you have $1.5 trillion of these loans coming due. And historically, if you looked at these interest only loans, the way they would be paid back is you have to make this big balloon payment at maturity. And they would do that one of two ways, either by selling the property and paying that debt off or by refinancing. And both of those today are going to become much more difficult. If they sell the property, for many of these properties, particularly in the office sector, you're going to have to take a hit in terms of the market value. And if they're looking to refinance, well, they're going to have to refinance at a much higher rate. It's going to be much more difficult to do so. So the expectation is, as we talked about a few times in the last month here, is that you're going to see much higher default rates for these CMBS securities. We're just in the early stages of that, but pretty much every day we're seeing these option adjusted spreads on CMBS securities go higher and higher. Now we're over 1,100 in terms of the basis points above the safer securities of similar duration. So this is kind of a slow motion thing that's going on. Not a lot of people talking about or paying attention to it right now. I suspect that's going to change throughout the year. And remember, who owns a lot of these loans? It's regional banks in the U.S. And if these regional banks are forced to sell these loans or take defaults on them or write downs, well, you can have more issues there. We haven't heard much about regional banks in the past few weeks. I suspect that's just on borrowed time here. This is an issue that I don't think is going away anytime soon. So something to really follow closely. So let's talk about the Fed. This has been jumping around as we talked about, from market expecting a hike to not expecting a hike. And Fed is meeting next week. So what are the odds saying today? This is very important because, as you know, as I say, every time the Fed meets, they do exactly what the market's expecting it to do. And it's very interesting here. The market is expecting a pause in June and a hike in July. And if we look at the odds here, this could change in the next week. But as of today, 72% probability the Fed is going to pause at that June meeting, keep rates at 5 to 5.25%. That would be the first pause that we've seen if they do that. So if we get to a day before the Fed meeting and this is showing a high probability of a pause, I think that's exactly what they'll do. But more interesting to me is that in July, the market's still saying the Fed's going to hike a 25 basis point increase here to 5.25 to 5%. And why I find that unlikely to occur, if they're going to pause here in June, why I find it unlikely that they'll hike in July is really the trend of CPI. And as we said, CPI peaked last June at 9.1%. It's going to hit 4.1% or low 4% according to Cleveland Fed when we get the data point next week. That's going to be a day before the FOMC announcement. And then when we get the June reading in July, which will be before the July Fed meeting, it's likely to drop to 3% and change. So the Cleveland Fed is expecting around 3.3%. So my question would be, if the Fed is going to pause in June with this 4.1% reading on inflation, why would they hike in July when they have 3.3%? Not likely, in my view, unless maybe this number comes in much higher than expected or we see some other type of shock. I don't think that the Fed is going to be pushed to act based on this type of number. I think it'll have to be after that point where they're seeing just persistent core inflation or something else that's bothering them. Then maybe they're forced to hike again. Interestingly, this week we did see Canada, after pausing for a number of months, hike again. But that remains to be seen whether that was just a one-off. But in terms of the Fed, if they do pause in June, I think it's unlikely that they're going to hike in July, but we'll watch these probabilities closely. I think what the Fed's going to start talking about more is the numbers that are coming down. If we look at rents, first decline in rents on a year-over-year basis since 2020. So Redfin looks at asking rents. So these are actual asking prices on rents. And all of last year, we're seeing these huge spikes higher in terms of year-over-year rent prices. And now we're seeing the opposite, where finally rents are actually going down on a year-over-year basis. Now, again, the CPI is lagging. It's not yet going to reflect this number, but with a delay, it will reflect it. And this is going to be a very important data point that the Fed is going to be looking at, given the high weighting that housing has on CPI. And why are rents expected to continue to slow in terms of the rate of growth? We have two big factors here. One, vacancy rates are moving higher. So you're seeing 7% vacancy rates now. It's the highest since 2020. And I saw an interesting article that was talking about another reason for these increased vacancy rates is homeowners are buying new properties, but not selling their old ones because they're having difficulty selling the old house, and instead they're choosing to rent out that home. So you're seeing increasing supply in terms of the rental market. And in terms of the looking ahead, the future rental market, we're going to see a real big jump in terms of supply, particularly for multifamily units. And we've talked about this before, but it continues to go higher. These are multifamily units under construction, highest level on record with data going back to 1970. So you're very soon going to see more supply. That should drive up vacancy rates, and that should keep rent prices at least capped. I don't know how much lower they're going to go in terms of outright price declines, but if they stay flat for a number of years, that's a win again in terms of fighting that higher inflation. So if we look at home prices, similar to rents, we're seeing this year-over-year rate of change go lower. 20 city index is now down 1%. This is the biggest decline we've seen since 2012 in the U.S. housing market. And now we have 10 cities. So 10 out of the 20 cities in this 20 city index are now negative year over year. So just a transition. We're not seeing huge outright declines, certainly not a crash. But in terms of the rate of growth, that's a slowdown. That's something the Fed is going to be looking at. Then we have supply chain. This is a chart we showed a number of times, but it continues to move in the right direction. Now down 88% from its 22-21 peak. These are shipping rates on containers, and we're back to 2020 levels. And it's pretty incredible that we're there. Hopefully we stay there, but this is going to be a factor to be helpful on inflation. If we look at market-based expectations and in terms of inflation, the Fed constantly talks about this, and we're seeing the best trend here we've seen since January 2021. We're close to 2% in terms of break-even inflation rates. A very good sign there as well. And finally, if we look at fertilizer prices, food prices, commodity prices, we're seeing this trend lower continue, down 64% from their peak. That's the lowest since January 2021. And this is a leading indicator for food prices. I think when we get that inflation report next week, we're going to see a big move lower in terms of the year over year rate of change in food prices. Love to see that. So commodity prices here, you see corn, I see wheat, big drivers here of inflation higher last year in terms of natural gas, crude oil, gasoline, all down significantly. Now you're going to see all of this be reflected in that next CPI report. And we just have the year over year comparisons very friendly in terms of these commodity prices. So all of the factors that were pushing up inflation last year are really pulling it down this year, and hopefully that continues. But June will be the month where we see this the biggest year-over-year declines, because that's when gas prices peaked last year, and after that we'll have to see how this plays out for the remainder of the year. Next thing I want to discuss, stock ownership, and this is an interesting poll that's put out by Gallup every year. And what they're finding today, 61% of people reported owning stocks in the U.S., and that's the highest we've seen since 2008. And after the financial crisis in 2008, you had a number of people give up on stocks. Stocks had gone down 57% if you look at the S&P 500. So naturally, a lot of people abandoned stocks. No doubt they expected to be able to buy in at higher prices. And we saw the percentage of ownership in stocks go down and stay down for really a number of years. And recently, we're seeing stocks move higher. We've had, of course, a decade of strong stock returns, S&P 500 doing great over this time period. So interesting to see similar to that sentiment chart, but really on a longer term basis here, stocks are way higher than they were in, let's say, 2013. But investors are more likely to own stocks today and to be happy about buying stocks. So interesting to see that. And it's just another lesson that timing your exposure to stocks, at least on a massive scale, if we look at the American public, they don't tend to do a good job of that. And in terms of 61%, is that too high? Is that a sell signal? I don't think so. You look during this whole period here, we have above 60% rates. There's no reason to believe that can't go higher in the future. And I think ultimately, if it did go higher, that would be a good thing. And if we look at the relationship between incomes and stock ownerships, you could see it's a pretty linear relationship. Higher the income, the more likely you are to own stocks. Of course, if you're employed, more likely to own stocks, and married as well, more likely to own stocks than not own stocks. So just an interesting study there by Gallup. So I want to end with something positive as we always do. And it's really good, a jobs report. And this is a trend that's been going on for some time. It's really continuing here. 29 now consecutive months of jobs growth. There was a big beat in terms of the payroll number that we saw versus expectations. That was a good thing. Very important here. I talked about it last month, but this continued to move higher here. Labor force participation rate, and everyone focuses on the overall one. You shouldn't focus on that. Focus it on the group that is still working. So this is prime age working, so 25 to 54. It hit its highest level since January 2007. So 83.4% of that age group now participating in the labor force, and a complete recovery and then some from what we saw during COVID. So people are coming back to work, particularly in this age group. That's a very good thing. The only, I guess, minor negative you would say is the unemployment rate did tick up. This is a different survey than the jobs report. They're looking at a household survey and polling people. And so a higher number of people said that they weren't unemployed. We'll see what happens with that number for next month. But I don't think that's this jump in the unemployment rate suggests that the job gains are over by any means. And I think the biggest factor driving this is still this gap between the pre-COVID trend in terms of jobs and where we are today. So we just had this huge decline in the number of jobs after COVID, and very slowly we've come back. We've surpassed the prior high, but if we had continued at that pre-COVID trend of around 1.5% per year, we'd be almost 4 million jobs higher than today. So that's not to suggest that all of those jobs are going to come back. There's a number of these people have retired, no longer in the workforce, but certainly there's still a lot of companies that need workers out there. And I think this job tells that story. This chart tells that story. Looking at the spread between the number of job openings and the number of unemployed, we're still at 4 million in terms of the spread. So you would expect this to come down in the coming months, both through job openings coming down and perhaps the number of unemployed coming down as well, and just seeing that spread narrow and narrow to the point where the labor force is no longer tight. It's starting to loosen. And we're seeing signs of that, I think, every single month in terms of loosening of the labor market. I think this is an important indicator on that front. Quit rate is down to 2.4%, which is back to kind of early 2020 levels here, down from 3%. So you're seeing a little bit more reluctancy in terms of workers to quit their jobs. So that's an indication that the labor force is likely to loosen. But there's no reason to believe, as I said, given this gap here, that we can't see many more months here of jobs growth. And talking about average hourly earnings, I want to end with this. Is such a big positive. We're seeing hourly earnings come down, so 4.3% over the year. So that's a positive in terms of perhaps inflation that is driving that. We're seeing lower levels of of wage inflation. But much more importantly, is that I think when we get that CPI report next week, if this is the CPI comes in around 4.1%, that will be the first time after 25 months consecutive of negative real wage growth. So 25 consecutive months where inflation outpaced earnings. We're finally going to see a month where over the past year, earnings went up 4.3% and inflation was 4.1%. So hopefully we get that number down in the low 4%, and hopefully we continue to see that going forward. As I've said, the path to prosperity is having this in positive territory. So the biggest problem with inflation is that people's wages don't keep up with that inflation and they lose their purchasing power. And we've seen that for 2 years. That's way too long. And the decline in the inflation rate is making this easier in terms of your wages keeping up with inflation. So hopefully, of course, that comes down and stays down. We're going to see that come down when we get that report next week and in July. With the July report for June, we're going to see an even bigger decline in CPI. So hopefully, again, we're on that path to prosperity and we'll keep it there. So let's end it right there. We discussed a lot today. Thanks everyone for joining me. Have a great weekend, and I'll see you next time.